So the private company transaction method. This is a method under the market approach. And there's some serious background we need to cover on this one. The method is based on the theory of substitution, which basically says that a buyer is not going to pay more for one business than they could pay for an equally desirable substitute. So there's some key phrases there. Substitute, equally desirable, and pay for, right? And remember, in business appraisal and similar analyses, almost everything is a proxy. And what I mean by a proxy is basically, well, here's a definition from Merriam-Webster. And I really want to focus on the first one and the last part of that first one. It's something that acts as a substitute for another. So in business appraisal, we're going to look at transactions of other businesses, analyze those transactions to come up with our opinion as to the value of the business that we're appraising based on this other data. So there's an analysis and proxies that stand in place. 5960, Revenue Ruling 5960, the Business Appraiser's Bible, lists a bunch of different factors to consider. Among those is this one, the market price of stocks of corporations engaged in a same or similar line of business. Then it goes on talking about having stocks actively traded in a free and open market. Now, back in 1959, when this revenue ruling was originally written, we didn't have these databases we have now, full of transactions of businesses that have sold, privately held businesses that have sold. So the market approach used to consist of only an analysis of publicly traded companies. Now, publicly traded companies are typically not that comparable to small, privately held businesses. Think of Home Depot or Lowe's or Menards as compared to a corner hardware store. The big box stores have access to a lot more inventory, capital markets, customer base, and if somebody gets sick, oh, well, they've got 1,400 other more employees. In a corner hardware store, the risks are different. Smaller inventory, if the key owner gets sick and nobody can open the doors, there's a loss of business. But thanks to business brokers, we now do have access to these databases. And here are some. So DealStats database owned by Business Valuation Resources. BizComps, Jack Sanders put the thing together. I think BVR, Business Valuation Resources, resells his database. ValueSource is one that's owned by NACVA. So you can access these databases that way. Each of those databases are sourced by business brokers who have helped buyers and sellers come together, transactions happened, and they report that data to these databases who then sell us access. Peer comps means the data that they have are those businesses that were sold either by a business broker or not, but they were strong enough businesses that they were able to obtain SBA financing. So typically the multiples that you'd see in the peer comps databases would be stronger than the databases you would see elsewise, because not all businesses can be financed by an SBA lender. And each business broker has their own database of transactions of businesses that they have. I'm going to focus on DealStats because that's the database I'm most familiar with. I use that most of the time. So for that one, let's have an example I'm going to run. So we're going to look at equipment rental companies, about $1.2 million in revenues last year. And the equipment company I'm looking at is a heavy equipment rental company. So the NAICS code, North American Industrial Classification Code, is 53241. So here you are with a fresh DealStats screen. We can look deals up by SIC code, NAICS code, sale date, net sales. All of these filters are what we can use. If you want to add a search field, you can. Occasionally I'll look at target business description, but I don't want to do that right now. So NAICS code, I like to start with that one. Heavy equipment rental is 53. Let's see, scroll down here. Click on 532, that one. Let's open this up, 53241. 41. So I've got options. I can stop here and get all of these, or, so that's 47 transactions, you can see down here. Or, if I uncheck that, I can look at just construction. I think that's the one I want. Okay, so let's scroll down here. I have 43 of these still. I'm going to change the view to 50. I want to see all 50 on a page. Okay, the revenue range, quite high. Let's narrow this. 43 is quite a few comps. Let's say net sales. The one that I'm pulling data for has $1.2 million in revenues. Let's look at 500,000 to, let's go 5 million. So now we're down to 13 transactions. Okay, that's doable. Let's look at those. Now, something else I want to point out here before I get into looking at these transactions. The private company transaction method for business appraisal relies on one other very commonly used phrase. Have you ever heard of quantity versus quality? So quantity is a lot of stuff. Quality means good stuff. So in the transactions that we're looking for here, we're going to look for quantity, not necessarily quality. There's a difference. When you're looking at publicly traded companies, you can get really good comps. You can have great databases full of great information. You can download 10Ks, 10Qs, get all the information you want to know about any of those particular companies. And you can then explain all of that information to your reader. Privately held businesses, however, we don't have access to that kind of data. You don't have the financial statements. You have the broker's information that they've summarized and then submitted to the databases. So the idea behind this method is you want to find as much data that's as comparable as possible to your subject and try to come up with an indication of value from that. Another point I want to make here, a lot of business appraisals that we're going to be working on, the point of the whole thing is to come up with a fair market value analysis for the company that's being appraised. None of these transactions we're about to look at, all of these here, not a single one of them was ever consummated at fair market value. Keep that in mind for a minute. Fair market value is a hypothetical construct. These transactions were all based on specific buyers and sellers negotiating out a deal. So it's more like investment value than fair market value. But we're going to use these transactions to come up with a fair market value analysis. The reason I make that point is because whatever these multiples come in with, we're going to measure a central tendency, average, median, or whatever. We don't have to use the average or the median. So let's look at these. Oil field equipment rental. I'm going to uncheck that one. It's not as comparable to what I want to look at. This is good. Sure, that one's okay. Equipment sales, new and used, no. So get rid of that one. Rents, specialty rental items to oil and gas industry. Let's get rid of that one. Rents, oil field tanks. Construction equipment, yep. Rental center, sure. Construction equipment. Yeah, sure, why not? All right, I'm going to come up here, scroll up a little bit higher, and there's this hide unselected. So now I have 9 comps. I'm okay with that. That's on the low end of what I'd like to have, but that's what I have. So you have these other tabs you can look at. Statistics measures what of the database that you have, the selected data, 9 comps. Gives you all of this 10th percentile, 25th percentile, median, so on and so forth, harmonic mean of all of this information. Let's explore if you want, but I'm going to come back up here to download. I want to download all available fields as an Excel file. You could download the PDF. I'm going to download all 9. All right. So first thing I do with this data, I select all of it and I widen all the columns so I can see all the data. Alt-H-O-I is my keyboard shortcut after I select them all. Now I'm going to go through and just look at stuff. See if there's anything else about this data that I need to be aware of. I'm still looking for the as similar as possible to my comparable. So these labels we've already looked at. That's why we downloaded this stuff. Target type. This is the type of business that we're. Sometimes you'll have comps that are publicly held. And I get rid of those. That's a different analysis. I don't want to mess with those. All right, let's scroll through here. All right, a Canadian business. Now, do we want to keep these? I'm going to highlight this one because I may or may not want to keep as reported in Canadian dollars or US. That's where I'll make my decision. Okay, let's see what else we've got. Keep scrolling through here. Acquirer type. This is another one that I'd pay close attention to. If the business that or individual who purchased the business that we're looking at in these databases was a publicly traded company, I also remove that transaction because publicly traded companies value things differently. They have access to different interest rates. They can get cheaper money to borrow to buy things. So it's outside of the fair market value realm entirely. So I get rid of those as well. Let's keep flipping through here and see what we've got. Net sales, that's the range that we specified. Okay. So earnings before taxes, operating profit. These businesses here are reporting losses. The business that I'm appraising reports a profit. So it's a bit stronger than these ones. So I'm going to mark them with a different color. I may or may not hang on to those. We'll see. This is right now, we're just still checking out the data and seeing what we've got. So I download all of the fields so I see what we have for each transaction. The other thing, if I go back into the website while I'm thinking about it, if you scroll down to these data points, and go back to the data tab, on each one of these, see this little page here? You can click on that and get the same information that we're looking at in the Excel file in a printable format. So you can get a really good look at each individual comparable and see what they're all about. So this is something you can look at that way. And it goes down a couple of different pages. I like to look at these fields in the Excel format personally. So that's what I'm doing. Okay, so this one, real estate. So this one right here looks like there is real estate as part of the deal. As I mentioned earlier, some business brokers will sell the business and the real property. Sometimes the real property is tracked. BVR does a pretty good job trying to remove transactions that are influenced by increased by the influence of real property being sold. So this is one that I'm going to pay close attention to on the far side. This market is so blue. Why not? So we know that this one, there was real estate involved. We don't always know. It's not always indicated. And sometimes the analysis that BVR does is they try to remove the impact of real property. Sometimes I don't believe they catch them all. We'll talk about that in a little bit. Okay. Sale date. Sometimes this is important. We have transactions that happened in 2021, all the way down to 2004, 1999, 1997. Some appraisers are of the opinion that old transactions are no good. They'd throw them out. I will test the data and see, because it's not necessarily the case. Certain industries just don't change over time, or there's very little, because inflation affects both sides of the equation. What we're not interested in each individual transaction so much. We're interested in the relationship between what was being generated by that business and what it was sold for. It's that multiple that we care about. And because inflation affects both sides of the equation, it'll affect the revenues and seller discretionary earnings, EBITDA, as well as sale price. So in my opinion, the old transactions are just as valid still, mostly, as current transactions. Still test to make sure, but we'll look at that. But that's a discussion on date we need to have. Well, another discussion we sometimes will have is on geography. Does it matter where a business is located? How will it affect price so much? Well, in my opinion, not so much. I mean, some states don't have an income tax. That affects their profitability. Therefore, if they're more profitable, they'll sell for higher prices. But what's the relationship between that profitability portion and the price that was paid? Again, I don't believe that's affected too much. So states that have income taxes and states that don't have income taxes, I can use transactions from both of them and still measure the associated risk with the company I'm appraising to come up with a multiple that I think makes sense. So in my mind, geography doesn't matter. The idea is, for example, an equipment rental company is going to operate pretty darn similarly if it's located in Massachusetts versus Texas versus Idaho versus California. Still going to have customers coming in to borrow equipment for a certain time period, charging by the hour usually. They use it somewhere off site. They bring it back either on time or late. They either clean them or they don't. And the company itself has to deal with that. Refill the fuel tank and then get it ready for the next person to borrow it. It's the same kind of operation, so geography, again, does not matter so much, in my mind. Seller financing is another issue to talk about. Some folks will say, okay, we need to adjust these notes to their cash equivalents. So in my mind, if they've charged them the buyer interest, that interest expense is part of the adjustment for cash equivalency. So I can use the overall agreed price in my analysis, regardless of whether there was seller financing or not. That's another one of those areas where business appraisers agree to disagree sometimes. This is the way I look at it. Ooh, transaction type. Here's a stock deal. Let's highlight that one as well. So, question about stock deals. Most business brokers will sell the assets of a business, meaning they'll sell the equipment, they'll sell the inventory, they'll sell the fact they have trained employees in place, they'll sell that there's already customer relationships, supplier relationships, they'll sell the name, the phone number, the website, all these assets that the business owns. They will not sell, the name is also part of those list of assets, but they won't sell the specific entity typically. Usually the buyer will create their own entity, file a DBA, and the name continues. On a stock sale, however, that's the entity that's being sold. Now, most businesses, when they sell, the seller will keep the cash, the accounts receivable, pay off all the liabilities. But if you're buying the entity, that's one of those things is unknown. You don't know if the buyer and seller agreed on a transfer of working capital or not. You don't know if there was a liability assumption is a part of the deal. So the multiples under the stock sales might be suspect. So I will most likely remove this one as well. Not removing it yet because I want to see the multiples so you can see what they are. Well, that's why I use different colors, so I can keep things in mind. Okay, anything else to look at here? All financial figures are in Canadian dollars. Okay, that's land purchase for $280. Price included in accounts receivable, note payable, not payable, not cash, not owner's personal autos. Okay. Here are the multiples. So now on this end, we'll do some math. This is why I like to do the analysis in Excel. So I'm going to do account, I'm going to do the median, I'm going to do the average, I'm going to do the coefficient of variation, and I'm going to do the min and the max. So if I have a lot more data, it becomes easier to do this kind of account. I'm going to do it this way, median, average. If I have a lot of data, I want to account so I can know for certain if I got 47 or 43 data points. Plus, I'm going to copy these formulas across to the other multiples. Not every multiple is reported, so that count will change. Coefficient of variation is the standard deviation, equal to ST, there we go, that one. We'll select the group here, divided by the mean, or the average in this case. And I want that to be down to 2 decimal places. There we go. Equals min. I like to know the range. What's the biggest and what's the smallest? So I'm going to copy these across there. So you can see there's only 6 databases that reported EBITDA multiples. There's 7 that did EBIT, 7 that did discretionary earnings. And I'm ignoring the market value invested capital to book value multiple because I think that one's silly. Plus there's only 2 of them that reported. So now I'm going to take a copy of this. I'm going to start deleting the ones I want to get rid of. Stock sale goes away. This one's a Canadian one. I'll stay with US dollars. Blue is one I thought might include real property. And they may or may not have removed it. We'll see. Okay, so we have 3 transactions that are over 1 times gross revenues. That's kind of the one I look for. Maybe real estate was included in those. Don't know for certain. It's a judgment call. You're going to have to make that decision. We know real estate was included in this transaction. It was stated in the notes. So I keep that in mind. I don't have a whole lot of data points to mess with, but in my mind, these 2 here, I'm going to remove, and that one, likely had real property involved. This one is up there, and that one's there. So, okay, so there we go. Coefficient of variation, pretty tight. Only 1 transaction left there, so that's not going to work. That's pretty tight. Not really enough data here in this particular database to use this method, based on the ones I removed. So I'm not going to put a whole lot of weight on the data in the appraisal that we'll use this report for. But just for fun, let's go back and look at, before I did all that deletion. Coefficient of variation on the price to sales was 0.75. Here, 0.22, a lot closer. Not nearly as min, half to 4 times revenues. Yeah, that's much closer range. I'd be a lot happier with this particular collection of data. I think it's a better example of just the businesses that are being sold. Discretionary earnings, we only have 3 transactions that report it. So 2 to 4 times SDE. That seems like a pretty appropriate multiple range. So now this is where things get interesting. If I had enough data where I could rely on this method to come up with a multiple for the valuation of the company, I'd be looking at one of these 2 figures, whichever one I felt like. So let's take the average, 3.28. Just come down here and grab it and say, would this be the multiple that I would use? Would this be the selected multiple? Not necessarily. This is the average, but average doesn't mean much. So the average of whatever data we're looking at is a conglomeration of all the collection of higher and lower multiples. Is the business that we're appraising, is it an average business? Maybe, maybe not. I'll go back and look at the financial ratios that I used, the comparative financial ratio analysis, to decide how that business rates as compared to its industry average. If those ratios indicate that the business is stronger than the industry average, then this multiple here might need to be bumped up. Instead of 3.28, let's apply, a 20% premium. equals that times 1 plus that. So almost 4 times. Maybe that makes sense. Maybe 4x multiple is what we want to use. Maybe that's better for the company we're appraising. It's more supportable. Of course, if those same ratios indicate that the company is weaker than the industry average, maybe we want to reduce the multiple sum, the average. If this is the average multiple and the company is weaker than the industry average, then the argument goes, well, how much weaker? Well, I don't know. We have to make that judgment call. It's up to each business appraiser has to look at the data and make that call. I'm going to say 0.5 just for fun here. So equals this times that range, I guess. Oh, I put a parenthetical there. Get rid of that. And round it. So maybe 1.6 times is the appropriate multiple. Or go 6 or 0.4%. Let's just knock it down that much. So that'd be the adjustment, right? So that would be this minus that. That would be the multiple that we'd be looking at doing. Get rid of all those extra zeros. It's up to the appraiser's judgment. So then you choose what multiple you want to look at. Scroll back up here. Do you want to look at the market value invested capital as divided by sales? I don't care for this one so much most of the time because it doesn't address the profitability of the business. Buyers buy businesses based on the amount of profits they're expected to receive. And an analysis of the revenues of the business does not include an analysis of those profits. So I don't like to use this one. It's the easiest one to play with, and sometimes it's appropriate, but in this particular case, not so much. I really like that one. Discretionary earnings, the SDE multiple. The only problem, though, is not all business brokers calculate SDE, or seller's discretionary earnings, the same way. Not all business brokers will apply the same types of normalization adjustments. Not all business brokers will look at the normalization expense for rent or payroll taxes if they're adjusting salaries. Maybe they don't even adjust officers' compensation. So there are still issues to deal with. But you select the multiple, apply it to the company's fundamental. So in this case, the business you're appraising, their seller's discretionary earnings. Apply whatever multiple you think that makes sense. In this case, if it's a stronger business, almost 4x. If it's a weaker business, maybe 2x. And then there's your valuation. So it all comes back down to your support for how you selected the multiple. Don't just use an average or median and be done. Because the businesses you're appraising are most often not going to be just an average or a median business. If you have any questions, that's how you can get a hold of me. Happy to answer any questions you may have.